welcome to Money Control. This is Shraddha Sharma and you're watching Editor's Take. In today's episode, we'll discuss RBI's circular that has asked banks to link fresh loans to an external benchmark. For that, joining us is Ravi Krishnan. Hi and welcome to the show, Ravi.
Hi.
So what is the gist of the RBI circular?
Well, as you pointed out, from October 1, banks will have to link their retail personal loan rates to an external benchmark. Now, this external benchmark need not necessarily be the repo rate or the policy rate. The RBI itself has suggested three options: A, the policy rate; B, the Government of India's 3-month or 6-month treasury bill yields, or any other financial benchmark which is brought out by FBIL. Now, all the RBI has said is that whatever benchmark a bank chooses, it should stick to that, so that loans are uniform within a certain category. For example, you can't have a personal loan which is linked to a repo rate, and you can't offer another which is linked to a 3-month treasury bill yield, for example. Now, typically the loans which you get as a consumer are basically a base rate plus a spread which the bank charges based on your credit risk profile. The RBI has said that this credit spread, the risk spread, it can't be changed arbitrarily. It can be changed only when there is a significant event that alters your credit profile, like for example somebody loses a job or somebody gets a better job, for example, so on and so forth. So, all in all, this move is going to lead to greater transparency.
Okay, so after the circular, what about the existing borrowers?
Well, existing borrowers can also switch to the new system without paying any fee, but there will be some what RBI calls reasonable administrative and legal costs. So, it will be beneficial because remember that the RBI has also said these rates, the new rates, should be reset every 3 months. So, what we can expect, because we are in a rate easing cycle, is that home and auto loan rates will likely come down.
So what, according to you, prompted this move by RBI?
Well, clearly for a lot of time RBI has been saying that transmission is not happening. It has been cutting the policy rate or the repo rate to boost lending in the economy, but that is not being passed on. So in the August monetary policy statement, the RBI did say that the weighted average lending rate for new loans, it has come down only by 29 basis points, while the RBI has cut the policy rate by 75 basis points. This was before the August policy cut, after which it has become 110 basis points. So also customers have been complaining that banks have not been like really transparent in passing on these loan rates. In certain cases, even if banks are cutting say the MCLR rate or the base rate, they typically increase the spread, so that the net effect to the consumer is not much. And finally, remember that the Finance Minister Nirmala Sitharaman said that she would expect all public sector banks at least to link their loan rates to an external benchmark to facilitate ease of credit and boost lending in the economy.
Also help us understand, how will this impact the banks?
Well, for banks, banks have been one of the main protesters against this for a variety of reasons, because banks are going to see their profitability getting squeezed. Their net interest margins could come down. One way in which they can avoid this is by linking their deposits also to floating rates. Soon we might see products like that, deposit products like that. But then also we need to see another impact could be that banks will now take a leading position in developing the market for interest rate futures in the country, because now they need to manage this risk.
All right, thank you for the insights on that, Ravi. That's all for today's episode of Editor's Take. For more news, views and updates, stay logged on to moneycontrol.com. Thanks for watching.